All right, welcome to this week's episode of DoubleLine Minutes. I'm Jeff Mayberry with Eric Dhall.
Hey, Happy New Year's.
That's right, it's 10 a.m. here on January 3rd. Happy New Year's to everyone, our first podcast of 2025. With this podcast, let's just go through what happened in the markets in 2024. Interesting time. Looking at the S&P 500, ended the year 2502. Kind of a bad December, down 2.4% in December. Interestingly, looking at all the sectors for 2024, all positive on the year. We'll get to that in a second. But all sectors except for consumer discretionary were negative in December. So not a strong end to the month. And certainly the last couple of weeks of the month really were the weakest part of the month.
If we look, you had a couple laggards in there, though, that just squeaked out a positive return.
That's true. Like we look at the sectors, the materials was up 20 basis points, so positive, but up 20. You probably don't feel too good about that versus the 25 of the S&P. Your best performing sector was communication services, up almost 35%. Financials was up 30.5%, and let's see, consumer discretionary up 26.6%. Those are your big winners. As I said, materials, your big loser, up only 20 basis points. Healthcare up 2.5%. And then both energy and real estate up 5 and change. So really those are your kind of outlier of your sectors. As everyone knows, the kind of the big mega cap names drove a lot of that performance. So those were in those consumer discretionary. Oh, and let's talk tech also. Tech was up 21.7%. So kind of tech, consumer services, communication services, and consumer discretionary. Big winners there. On a month-to-date basis, S&P was down 2.4. Looks like consumer discretionary, the only positive sector, up 1.1. Your big loser, materials. I guess that's why it was up only 20 basis points on the year, was down almost 11% in December. Other sectors that kind of gave a lot of returns back, energy down 9.5%, real estate down 8.5%, and then both utilities and industrials down 8%. So a pretty weak ending to the year. We kind of go to the Russell 1000 was up 24.5% on the year on 2024. Russell 2000 up 11.5%. So your small caps underperforming. The similar with December with the Russell 1000 down 2.8%. Russell 2000 down 8.25. Let's call it. Similarly with growth, Russell growth up 88 basis points on the month. Value down 6.8% on the month. Kind of similar story for the year. Russell growth up 33.4% and value up 14.4%. So a pretty big underperformance from value versus growth for 2024. And if you look at the equal weight, S&P equal weight up 13% on year to date. So you've underperformed both value and growth there. In the month on December was down 6.3%. So obviously good overall year if you bought the S&P 500 and just wrote it out. The Rip Van Winkle portfolio, as we like to say, you're up 25%, which probably feels pretty good. If we shift over to bonds, if we thought about how we started the year with, the 10-year was at 388, the long bond was at 4, kind of feeling like, okay, and the 2-year was at 4.25. We're thinking we got some yield. Let's see what kind of returns we can get here. But we did end up the year with the 10-year at 457. The 2-year at 424. So the curve actually uninverted. It's steep now at a 2/10s at a 33 basis point difference there. And so if you kind of look at it on a year-to-date basis, the 2-year was flat basically, maybe down a basis point. The 10-year was up 70 basis points and the long bond up 75.
Yeah, I thought that was a pretty interesting dynamic, how the curve kind of just flipped around that fulcrum point of the 2-year, which, as you just mentioned, stayed at that kind of 425 area and didn't even budge barely. But obviously the front end of the curve with the Fed cutting rates dropped pretty significantly and the back end sold off.
Yeah, the 3-month T-bill is down 100 basis points and the Fed cut 100 basis points. So moving in line there with what the Fed did. But Eric, as you said, that 3-month, if we kind of look at that 3-month 10-year, which is kind of the academics way of looking at the curve steepening and causing portending a recession, the 3-month to 10-year started the year at negative 148 basis points ended 2024 at positive 24 basis points. So a big 172 basis point move there on the 3-month to 10-year. So with that being, positive sloping again, that, historically would be the sign of a recession, and that did uninvert, in December. If we look at the returns, though, as you would expect, given the rising interest rates, returns on the fixed income weren't too great, with the Bloomberg Aggregate Index up 1.25%. So luckily, we started the year with that with some yield. So we did eke out a positive return there for the ag. The worst performing sector out of kind of the aggregate sectors was government bonds, up 0.5%. Agency mortgages up 1.25%, and then investment grade corporates up just over 2%. So investment grade corporates, with their spread tightening that occurred over the year, continue to be the best performer. Your non-index sectors were the best performers. High yield up 8.25%, bank loans up 8.75%, and EM up 6.25%. So if you were able to invest outside of those Bloomberg aggregate sectors, you did get some outperformance from those riskier sectors of the market. On the month, though, with the 10-year up 40 basis points in December, the ag turned in a negative 1.6% for December. Looks like investment grade corporates was the worst performer there, down 2%. Agency mortgages down 1.6%, and U.S. Treasuries down 1.5%. But if you hung on, hold your bank loans, hold those floating rate assets, they were up 50 basis points on the month. High yield was down 50 basis points, and then EM was actually outperformed the investment grade corporates, but was down 1.6% on the month. It's kind of a mixed bag in December, but positive across the board for 2024. Even though I guess your treasuries at 60 basis points, you did better than materials from the stocks, and with a much smoother ride. We shift over to I guess we could talk about smoother rides or not smoother rides. Let's go to commodities. The Bloomberg Commodity Index was up 5.4% on a year-to-date basis, and up 1% in December. Looks like your big winners, as most people know, is precious metals, up 25%, even though it was down 2.2% in December. And then livestock was also up 20.2% in 2024, but fell 75 basis points in December. Your other kind of to round it out, energy was up 1.2% for the year, even though it was up 6.5% in December. And industrial metals were up 3.5% on 2024, down 3% in December. Kind of looking at crude oil, ended the year at I don't have it. I have the last. I don't have the I don't have the last one. But crude oil was up 6% in December and ended up the year up 14%. That's on a total return basis. So if you rolled the futures contracts every month, you'd end up with that 14%. And gold was up 26.6% for the year of 2024. Sorry, Eric, did you have anything to add in commodity land there?
I was just gonna say, yeah, that pet rock, pretty interesting. People seem to be hoarding that, and Bitcoin did quite well as maybe global consumers are worried about inflation in the back of their minds. One kind of interesting macro tidbit I read is in India, the Indian trade deficit was one of the worst in history because of all of their imports in gold and the strong dollar. So that's just, another data point, as the dollar's very strong, close to all-time highs now, and had a very good year. Just something to keep an eye on.
Yeah, and I was looking here, so I as Eric, as you were talking, and I could pull up oil prices. We started the year at 71.65. We ended the year at 71.72. So flat from a dollar price basis, but if you were able to kind of roll those contracts, you cranked out a 14% return, which was nice if you can do that in commodities. It doesn't work for you all the time. Also, Eric, is interesting, as you talked about Bitcoin. I saw a chart today that said that Bitcoin inflows into the Bitcoin ETFs have actually turned negative, and their peak asset flow was on December 18th. So as soon as the Fed cut rates, those flows into Bitcoin, cut rates another 25 basis points, those flows into Bitcoin stopped, and there's actually been outflow. So just thought it was interesting. Obviously, one data point could be a coincidence, but interesting nonetheless. If we shift over to kind of what's been going on over the past week or so, or where we are today, as opposed to the end of the year. We're looking at a 458 on the 10-year, 426 on the 2-year, interesting start to the year. But Eric, why don't we get into how things, or kind of from a macro perspective, what's gone on this week? Even though hasn't been much, it's been pretty quiet. But over the last couple weeks, and then next week, what kind of to look forward to?
Yeah, for sure. I mean, we'll just give you guys a quick catch up because of the Christmas week. We were enjoying time with our families, and we hope you were too. So Monday, December 23rd, we got the cap goods orders, and the thing to note is, I'm not going to go through everything that happened that week, but the cap goods orders, non-defense ex-air, came in quite strong, positive 0.7, where the estimate was 0.1%. So that was a big beat, and that's one of the better growth months we've had, the best since August 2023. So kind of an interesting thing to look at, and we got some data later this week that kind of corroborated that. Looking at the initial jobless claims, also nothing burger there, came in at 219,000, so pretty much in line with the moving averages. And continuing claims, same story, nothing really to report. But kind of shifting to this week, which, as Jeff mentioned, is a pretty light week, we still got some data came out. We got the S&P CoreLogic K-City 20 K-Schiller 20 City home price index for October. So that's on a bit of a lag, but looking very strong. The housing market up 4.22% year over year. So for all those homeowners still building that home equity, on a month over month basis, still came in at positive 0.32%, which was above the estimate of 0.2%. So still have strength in the housing market. We have that kind of rate hangover as many homeowners have refied, and just people are holding on to their mortgages and staying put unless they really get a great offer or they have to move. So that's just given strength to the housing market.
Yeah, and we're keeping rates are still at that like 7% level, so it doesn't really seem to be any catalyst to move in either direction right now.
Yeah, just continued strength there. On Thursday, we got initial jobless claims for this week, for the week ending December 28th, and that came in at 211K, so a little lower, but I would say in the range that it's been in. And continuing claims came in at 1,844,000, which was about 50,000 less than the estimate, and kind of inside of the prior by about 50K as well. So I would say it's in the range, but positive. No alarm bells there. And then today, January 3rd, we got ISM manufacturing, and that came in at 49.3, which was a beat from the estimate of 48.2 and a pretty big beat on the prior of 48.4. So manufacturing has been looking somewhat positive in industrial goods. So I don't know if there's too much to read into this data, but it's definitely not negative.
Yeah, it's definitely, I guess as you get closer to 50, it makes it feel a little bit more balanced. If you look at one thing I would look at was that the new orders increased to 52.5. And then, part of me wonders whether that's just people trying to get ahead of any potential tariffs and kind of loading up on inventory there. But that obviously remains to be seen, and we'll have to see whether, as I like to say, one data point does not make a trend.
Yeah, I think that's a good point. I read anecdotal stories about that concept of businesses trying to build up their stocks so that if there are tariffs, they're kind of neutralized a little bit in time and they can wait and see how things shake out.
Yep. Let's shift over real quick because it doesn't seem to be a topic of conversation, at least over the past couple of weeks, is the Fed. The Fed meeting is on January 29th, so we have a few weeks here until that happens. We're still looking at an 11% chance of a cut in January, gets to 50-50 in March, and market is pricing in 1.7 cuts for all of 2025. So it'll be interesting to see how that shifts as the data comes out. And I guess this is typical of where the Fed is very data dependent. And so as we get into next week, which is a busy week for terms of macro, how those market odds shift in the Fed if the weak data comes out, whether there'll be more Fed cuts priced in. And with that, Eric, you want to hop into what to keep an eye on for next week? It is a busy week.
Yeah, let's kind of jump into that. We won't go into all the numbers here, but we'll just give you a heads up on what's in the pipeline in terms of data. I think there's a bit of catching up to do in the new year. So we get JOLTS on Tuesday, and that's always something to watch, albeit the data stream is some people take it with a grain of salt, but that's job openings, and it's a labor market indicator that the Fed watches and Jerome Powell watches. So watch for that on Tuesday. We also get ISM services on Tuesday, and that's been in the growth territory. The prior was at over 52. The estimate is over 53. So we'll see what happens there. It's also, unemployment week. So we're going to get the unemployment data. We get the ADP unemployment report on Wednesday, which is, I don't know if the market really trusts that, but the estimates for 130K gain. We get consumer credit on Wednesday as well. And then we get Thursday, we get the initial jobless claims and continuing claims. So we'll keep an eye on that. Also get wholesale trade sales on Thursday and wholesale inventories. So that could be another thing to watch if maybe there was some buildup of inventories in anticipation of tariffs. Maybe that could be positive. We'll have to wait and see. And then on Friday, it's Jobs Friday. The change in non-farm payrolls for December is predicted to be 153K. The prior was 227. If you remember, that was a relatively strong print above estimates. So we'll see if this 153 is right, or if the labor market shows resilience. The unemployment rate is predicted to be 4.2, right on its prior. So that's that. And we're naturally going to get the labor force participation rate and the underemployment rate. So definitely something to keep an eye on for next week, along with the University of Michigan sentiment surveys.
Yeah, Eric, as you were talking, I was wondering whether the jobless claims data will come out on Thursday, because Thursday is the day of remembrance for President Carter. So stock market is closed, bond market's open half day. So I guess maybe with the bond market open, that's probably why the bond market's open, in case the jobless claims numbers come out, one way or the other. Bond guys like to trade those types of macro factors, and a lot of times the stock guys will just wait and see what happens. But just another reminder that'll happen next week. So when you do see the market's not moving on Thursday, that is why.
That's a good point. Rest in peace to former President Jimmy Carter. Did a lot of great humanitarian work after his presidency.
That's right. And with that, I think that wraps it up for the first podcast of 2025. I'd like to thank everyone for tuning in.
Yeah, thanks to all our listeners out there today on DL Minutes. If you have any questions, you can hit us up on Twitter. You can get us on our email. We'd love to get some more feedback for a topic to fill the topic of the week calendar for the year ahead. And we're always open to suggestions. Also, don't forget to look at our YouTube channel, youtube.com/DoubleLine Capital. Thanks for tuning in.
Yep. And I'd like to thank our former host, Sam Law, for tuning in today. Sam, hope you enjoyed it and learned something here. So with that, I'd like to hope everyone has a great weekend and to a great 2025.